Manish Sonthalia, Senior Vice President and Head of Equity Portfolio Management Service for Motilal Oswal AMC is ready, and let's connect with him. Manish, good morning. Thank you for joining us.
Morning.
Is the worst of the print behind us for the year? You think globally and locally things are looking settled and the trajectory is higher?
Well, look at it like this. Dr. Rajan has cut rates by 50 basis points, and the Fed chairman is not going to raise rates anytime soon, maybe sometime in March or thereabout. So 7,500 to 8,000 on the Nifty is a good level. We should find support, come the worst, and I don't think there's anything India specific that could lead the markets below 7,500. So my sense is we should build on gains even from the current levels, but the numbers and the earnings have to support, and I think that is more of a given from the third quarter onwards, maybe not in the second quarter also.
Manish, hi, good morning. How critical is the market, really observing the Bihar election, because the pre-polls are hinting at a JDU Bihar win?
Yeah, I mean, that remains a joker in the pack, and we shall know when the results come out. I think markets today are building in some sort of a win for the NDA per se, and if things were to be otherwise, then definitely that's going to have an adverse impact, because it would become even more tough for the ruling government to pass critical bills, etc. in the Rajya Sabha. So yes, that's something which we'll have to live with, and we shall know that only in November. But till that time, I think it's global cues which are going to lead the way for the markets.
Right. Manish, what's the expectation from earnings this time around? I mean, we kickstart with two index names today and Monday, IndusInd Bank, Infosys. Let's talk about Infosys and the IT pack at large. You think any disappointments, if at all, already priced in?
So September quarter is one of the strongest quarters for IT companies. Volume growth should be in the range of 3 to 4% in constant currency terms. For Infosys, I think anything more than 4% in constant currency terms would be looked at as a positive. And if there's anything below 4% in terms of constant currency, we should look at, the markets would look at that as negative. There would be cross-currency headwinds, but there won't be any wage costs, there won't be any visa costs, wage hikes and visa costs. So in all, they should be on course to meet their yearly guidance of 10% or thereabouts growth in constant currency terms. If that was to come about, I think the levels would hold, but it would be more a case specific in individual names, and that I think TCS and Infosys would be better placed than the rest of the pack. As far as the overall earnings numbers are concerned, I think if you remove the metals, the oil companies and JLR, I think we should be there with a 10% sort of a profit growth for the Sensex.
Manish, if I scan through some of our previous interactions, and my understanding of your portfolio is that you're still sticking to the good old iShare and the Page Industries. So at a time when markets are looking to rotate out of quality to growth cyclicals, are you happy to own those good old quality names?
So markets have been trying to price in cyclicals a long time back, and nothing has come about. I think even now things are not very clear as to how the cyclicals and the domestic cyclicals, whether it be the infrastructure pack or whether it be the private capex or cement, etc. The numbers just are not there. In the backdrop of that, if you look at some of the consumer companies, when the earning numbers are all over the place, even for this quarter, you're looking at consumer sector growing at something like 18% in terms of profit growth. Yes, it may not come through very good volume growth, but margin expansion will lead to some sort of 18% sort of a growth. So FY17 also you will look at a volume growth. So India is more of a volume growth story for FY17. In FY16 it would be more of a margin expansion. On the other hand, the domestic cyclicals, there's just hope, and we all hope that things should move forward, but numbers would have to be justified before we take a call, because even with the existing numbers, order book, etc., nothing is available at very comfortable valuation. So it's rather safe to be there with stocks which have decent numbers instead of companies where we hope numbers would come, and even then the valuations are not very comfortable.
But the flip side of the argument, Manish, is that where growth visibility is there, those stocks are priced to perfection. Whether it's a Nestle or a Page Industries or Aisha for that matter, some of these stocks or Maruti for that matter. I mean, some of these stocks are so expensive that if you buy them, can you really make money now?
So it depends on your hurdle rate as to what sort of a return expectation you are having. My portfolio is designed to have a hurdle rate of 15%, which means that we should expect to double our capital in 5 years. And given the cash flow situation, I don't think it is the near-term valuation that people are worried about. It is how long that growth is going to last. Whether we are going to be correct on that aspect or not is something which we need to figure out. So I remain fairly comfortable on the names that we have in the portfolio with regards to the longevity of the growth. And if the longevity of growth is there and we have a terminal value given the risk-free rate that we have, and some sort of a terminal growth rate that you build in, and if you build in with a 15% hurdle rate for your clients, I think most of my companies would stand justified even at the current prices.
So where have you added positions, Manish, in the recent fall that one has seen in the market?
So, I mean, we have really not made too many changes in the portfolio because things have been very uncertain as far as some of the cyclical names have been concerned, and I think more or less the stocks that we have in the portfolio are performing. There have been corrections. Yes, the markets have corrected from 9100 to 7500, and so there is some sort of a market risk that is also built in the portfolio. Portfolio has also fallen in more or less in line with the market. So I think these are some of the best stocks that are there in the portfolio, and we're happy sticking with them. We have really not made too many changes.
Manish, on various interactions that we've had with you off and on air, you've shown your penchant for picking up some of these consumption related names, be it the theme of people buying heavy motorcycles and Aisha thereof, or a few others. Of late, there are a lot of consumer companies which are coming out with specific news. I mean, the Arvind tie-ups that are happening, Future Retail and the Patanjali tie-up, and how those stocks are reacting, or a bunch of other names. Is that still a sweet spot? And if so, within the wide basket of consumption, where do you think people will find the biggest bang for the buck?
I mean, this is a long-run story for India, that consumption piece is only going to get bigger. In the immediate short term, it is the urban consumption space which is going to do better than rural consumption, because urban consumption would have a very low base given the impact of inflation on urban consumers in the last 4-5 years. That will get alleviated sometime soon, and second half should see a pickup. On an overall theme for the next 3-5 years, I think consumption space, and within that even food, food is going to remain the biggest space within consumption. It's going to grow the least in terms of percentage terms, but the space itself is very big, and there would be room for enough players. If somebody has a niche presence in any of these areas, there's enough opportunity for him to scale up and make money. Similarly, skin care, hair care, these are some of the niche consumption areas which to my mind should do well going into the future.
You've liked pharmaceuticals in the past. We've discussed Ipca, we've discussed Sun Pharma on several forums. Without getting into a company specific explanation, let's understand the regime. And the regime for pharma is that new product launches are slowing down. US FDA is clamping down. Ahead of US election, US generic pricing is not going to move up, it will only come down. So do you think there is a structural risk now to Indian generic companies? So far they've really gained market share, the margins are brilliant, but now is there a chink in the armor?
No, I think this product approval thing is only going to get better. We had GDUFA issues in the past, and that is getting resolved. So we'll see bunching up of product approvals, and that is the big bet on Indian pharmaceuticals going into the next 1.5-2 years. Applications have been filed, and they have been the pending applications have been there for more than 2.5-3 years. Now that will tend to get resolved. So in the past it was a case of product approvals. Now that aspect is getting alleviated. So It will come on the back of newer launches, and that would be price specific. It would be all molecule specific, generic specific as to where there are shortages in the US market, which will see some sort of a price increase, like HCQS, it's seeing a massive increase in prices, or even generic Nexium, they're not seeing the erosion to that extent, or some of the launches by pharmaceutical companies where there are shortages, you're really not seeing too much of a price correction. So on the one hand, you would have product launches, you will have not very severe pricing erosion. That would lead the way for earnings growth. I agree with you that valuations for generic pharma companies, whether large caps or mid caps, are somewhat on the higher side. But again, it is how long the growth is going to last for each of these names.
Okay, Manish, we could go on chatting, but thanks so much for taking the time out and speaking with us today.
Thank you.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.